Good afternoon, everyone. It's my pleasure to welcome all of you to Colliers Q1 Philippine Property Market Briefing. I'm your host, Maricris Sarino-Joson, Colliers Senior Director and Head of Office Services, Landlord Representation. We are honored that you're able to find time from your busy schedules to attend our briefing and listen to our experts take in insights on the current and future prospects of the Philippine real estate market. Colliers, as you already know, is more than pleased to provide you a platform for the exchange of experts' insights and exploration of innovative strategies and the fostering of collaborative relationship that will propel our industry forward. But before anything else, let me acknowledge the partners who made this event possible: Makati Business Club, Philippine Chamber of Commerce, SharePhil, Subdivision and Housing Developers Association, Australia-New Zealand Chamber of Commerce Philippines, British Chamber of Commerce of the Philippines, Healthcare Information Management Association of the Philippines, Organization of Socialized Housing Developers of the Philippines, Billionaire News Channel, ANC, The Manila Times, Inquirer Property, Business World, and the Philippine Star. I know everyone is excited to know how the real estate sector performed in the first quarter of 2025, and we have prepared a packed program today as we will discuss the office, residential, and retail sector. So in the next 2 hours or so, we at Colliers will do our best to provide you insights, recommendations, and some assurance that will guide us through 2025. I would also like to ask you to scan the QR codes or click the link displayed in the chat box displayed on our screen for a quick survey, the results of which Joey will share at the end of the program. So with that, let's begin our briefing. 2025 is proving to be anything but boring. In the first 3 months of the year alone, we've seen events that spook investors, not so positive developments in both the office and residential sector that will make us doubt the market's post-pandemic recovery. But at the same time, we are seeing really positive signs that the sector is evolving, thriving even. The office sector continues to dodge 20% vacancy despite POGO exodus. Key occupiers are taking advantage of the market that favors them. Developers and investors are seeing the allure of residential projects outside Metro Manila, negating the impact of condo demand in capital region. And the retail sector is proving to be an even brighter spot. We're seeing the significant changes in some of Metro Manila's well-loved malls, the entry of foreign brands, and the mall traffic surpassing pre-pandemic levels. While we anxiously watch the local elections unfold and whether a new set of lawmakers will have any impact on the current administration's economic policies come June, we wonder what the rest of 2025 has in store for us. So to start, let me call in my colleague, Colliers Director and Head of Office Services, Tenant Representation, Kevin Jara, to discuss the office sector.
Thank you, Chris. Good afternoon, everybody. Okay, so as Chris mentioned, we did see some positive signs already in the first 3 months. Particularly for office, we actually bounced back from negative net take-up recording for full year 2024. We're now at positive 77,000 actually, 77,000 square meters just for the first 3 months of this year. Vacancies, as Chris has mentioned, still below 20%, but it's still stable. It's not, at least it's not still increasing because we did see some non-renewals still happening in the first quarter. But there are some areas in Metro Manila, in other sub-markets like Makati CBD, where there was a steady decrease in vacancies in that location. But because of very recent geopolitics and always shifting trade policies, we're still keeping our year-end forecasts for the end of 2025 at 150,000 net take-up. So right now we're at 19.7% vacancy rate as of the first quarter 2025. If you recall our previous report, that number was 19.8. No? So very little improvement was seen over the 3 months in terms of vacancy rate, because even though we did do a lot of deals in the first quarter, there were still some vacated spaces or surrendered leases, as I will explain more in a bit. And as I mentioned, we did do well in the net take-up category. So that's positive 77,000 square meters from negative 45 for the entire 2020 year of 2024. We're still keeping our 150,000 net take-up for the year-end forecast and 22% vacancy rate. Because of what's happening in geopolitics and the trade policies that's happening right now, we don't think that there's really a direct impact to the office sector in the Philippines. We actually think it might be a boon to our outsourcing industry because cost pressures from North America might encourage actually more outsourcing here in the Philippines. And as we all know, outsourcers are the primary or the major office users in the Philippine office market. The bump in first quarter transactions was actually expected because based on our historical data, whenever there's a US election, there normally is a 30% drop from the third quarter of that year down to the fourth quarter. But then again, after the subsequent quarter, there's always a 40% uptick from the fourth quarter. So, but actually in 2025, we actually outperformed that average. No? We did 66%. We have a 66% increase from the fourth quarter of 2024. So that's 143. And right now we are at 238,000 square meters of office transactions in the first quarter. 238 also outpaces the average quarterly volume for the entire 2024. So we're hoping that it's setting the pace for the rest of the year. And yeah, it's a good sign for if current conditions, there's no really big shocks in terms of regulation or in the economy that would affect the market. So we're expecting that number to be sustained or even improve as the year moves forward. Traditional companies took 61% of the office deals in the market in the first quarter. And we think actually that's a good thing because it means all types of companies, not just the BPOs, are in the market for office space. So everyone is in the market for office space. And you have here the typical traditional tenant industries or the tenants that are in the traditional classification that are not BPO. So you have government, transportation, flexible workspace, banking, and IT taking up space. Although traditional office or a traditional companies still prop up the office demand for Manila, the BPO still do the large deals in the market. So with the likes of Diversify, Global Payments, Everrise, InTouch CX, doing deals in CBDs and also outside CBDs like InTouch was in Green Hills, just outside of Ortigas. Fort Bonifacio is number one or the most active market as of the first quarter in terms of deal volume. While former number one, the Bay Area, which saw a lot of deals last year from government agencies, was relegated now to sixth place as of the first quarter. But what's also interesting here is that there's a consistent performance in the Makati CBD market. No, we saw a 189% increase year on year on office transactions in terms of square meters, and it's also doubling its Q4 numbers this quarter. So non-BPOs propping the market, BPOs doing the big deals, and that's also still that industry, the BPO industry, is still contributing positively to the net take-up of the office market with their expansions. So 66% are really organic growth from BPOs and shared services. No, So that includes new setups of about 10% of the deals, but 56% would be expansion from the existing BPOs that we already have in Manila. And that's comparing to 56% in percent in the full year of 2024 in terms of motivations for getting office space. So as mentioned, we did still see some non-renewals in surrendering spaces. We actually did see some POGO spaces or POGO leases being ended, still being formally ended as of the first quarter. Operations technically have stopped due to the POGO ban last year, but there were some carryover of lease expiries in the first quarter. That's why we still recorded some 82,000 square meters of expired leases this quarter in first quarter. But taking out POGO, no, the average non-POGO, the pace of surrendering and non-renewing of the lease is about 130,000 square meters per quarter. But we're actually expecting this number to decrease as we move forward this year because we're expecting most of the leases that were signed pre-pandemic, more than 5 years ago, to start ending this year. And, you know, essentially, most of occupiers have already rationalized, or we hope have already rationalized the office leases and footprints and have determined a way forward for their office space. So the last time we did this slide was in 2020, actually, when we were still hopeful that some pre-leasing were going to be converted into actual demand, no? But eventually we had to face the pre-leasing slide because in the years after, or even the months after the COVID hit, the pandemic essentially erased pre-leasing activity. So right now we're welcoming this slide back because pre-leasing is actually a very good market indicator because it future-proofs your net demand by converting deals that were done in the past into actual demand by the time the buildings that were in the deal reaches completion. So we saw some pre-leasing happening outside of notable ones outside BGC, no? We saw a couple in Quezon City. So this is not like comparable to the heydays where we had 60% of buildings under construction already pre-leased. But we are starting to see some signs, no? And particularly we're seeing these in complexes with existing players or occupiers expanding within those complexes and going for the new builds in those master plan developments, like in Areta, Cubao, and in Robinson's Bridgetown in their newest building, GBF Center 2. And then actually, 61% of the net take-up that we recorded this quarter, that's about 46,000 square meters out of the 77, is actually a pre-leasing deal converted into actual demand because the building is already complete as of this quarter. So, although overall vacancy is flat, as I mentioned, 19.7 compared to 19.8 by the end of 2024. We're seeing improvements in vacancy rates on the sub-market level. So improvements we're seeing in your CBDs, Ortigas, Makati, even in Quezon City. And on the ground, the decreasing availability is even more pronounced in places like Makati CBD, where yes, you have 244,000 square meters of available space, but those are in a lot of small units, partial floors, essentially not contiguous available space that you would normally see in a brand new building. So the For example, a requirement of about 10,000 square meters in Makati CBD will only yield you a handful of office buildings in that area. And speaking of Makati, with the current pace of transactions happening in Makati, the non-renewals, including non-renewals, the current pace of non-renewals in Makati, we are actually seeing a potential entry to a landlord's market as soon as next year. That's 5% vacancy. So, given the trends right now, and hopefully that transaction activity will be sustained in the CBD, that the conditions might shift already in the CBD. But landlord market conditions in Makati may only last until 2028 or be sustained further, depending on how you look at it. Because by 2029, we're expecting a couple of buildings to come online in the CBD, particularly HQ buildings from the country's largest banks. We estimate more than 300,000 square meters of new office space coming from HQ buildings in Makati CBD. That will be built by the country's largest banks like BPI, BDO, Metrobank, China Bank. And then, of course, we think that majority of these spaces in these buildings will be used by the banks. But assuming the primary intent of these building designs was to maximize FAR allocations in these properties first, then there might be a possibility that some space will be available to the market when they come online. But yeah, if indeed these will really be solely for end use by these banks, then definitely we will see a protracted landlords market in Makati in 2029 or 2030. So Joey will speak more about the proposed zoning amendments in Makati CBD in a little bit. But we do think that there's a potential opportunities for additional supply, of course, with the redevelopment of properties in Makati due to the updating of the zoning by Masaya. So the proposed amendments include, updating FAR allocations in Legazpi Village and Saucedo Village, but also at the same time introducing mixed-use classifications for areas along main thoroughfares like Ayala Avenue. So based on our estimates, the maximum yield for additional office space, if in these areas will be converted solely for office space, could be as high as 2.6 million square meters. But we think that any zoning updates in Makati should be accompanied by other enablers such as the Condo Redevelopment Act to allow aging properties to be redeveloped, and additional incentives focused on introducing sustainable design and technologies for the new properties. In rents, generally in Manila, Metro Manila, quite stable, just a small decrease of 1%, 1.4% across the board. But there are some interesting developments, such as in premium buildings in Makati. We saw an increase of 3% in just the first 3 months of this year, so quarter and quarter. So actually, one building in Makati by one of the biggest developers here actually has already reached 2,000 pesos per square meter in terms of headline rates due to already dwindling supply inventory in that building. So the behavior for Makati premium buildings really follow what we think follow normal behavior because there was a reduction of office stock in Makati since 2021. So about the 47% of premium stock in Makati has already been gone since 2021, and of course that led to some increases in the rents already, particularly for the 3% just this quarter. In Makati Grade A buildings, the inventory is also decreasing, but rents are also slightly also decreasing. And this is where we think the age of the buildings is already coming into play. As you know, and we wrote about this in our white paper last year, 70% of aging properties are actually located in Makati. So we think that, a lot of factors come into play when it comes to it, but definitely the building age and the quality is certainly up in the considerations for pricing. And then just a quick update on the provincial markets before I end our update for the first quarter. So BPO deals in markets outside of Manila are still sustained. In fact, we did a little bit better first quarter of 25 versus 24, where we did 55,000 square meters of space versus 46 last year. And also interesting to note that in some markets, like for example, Davao is we think within the landlord market territory already with 6% vacancy and no substantial supply pipeline in the coming 1 or 2 years. So to recap, we're doing better first quarter in terms of deals, both in Manila and the provinces. Vacancy rates remain flat, but net take-up is definitely back in positive territory this quarter. And we hope the activity for the first quarter will set the pace and tone for the rest of the 3 quarters that we still have for this year. Makati, for us, interesting with the zoning updates and possibilities. There's currently dwindling availability in the CBD, but that might change when new buildings from HQ of the banks will come online in 2029, 2030. So that's it for the office sector, and giving it back to Maricris. Thank you.
Thanks, Kevin. We've been receiving lots of questions for the office sector, but we'll discuss that later. Before Joey's excited to present, but Joey, they need to answer your survey so you can flash the results later. So please, everyone, scan the QR code or click on the link in the chat box. So Joey and his team needs this information so that they can flash it and share it to everyone at the end of the Q&A later. Now to present the macroeconomic outlook and to discuss the residential and retail sector, I'm pleased to introduce our next speaker, Colliers Director and Head of Research, Roi Bondoc.
Hello, Maricris. Can you hear me?
Crystal clear.
Yeah, thank you, Maricris, for the introduction. Again, I'm Roi Bondoc. I'm the Head of Research at Colliers Philippines. I will be presenting updates on the Philippine economy and the Philippine property sector in general. Maricris, I just want to check if you can see my presentation right now.
Yes, I can see you and I can hear you.
Thank you, Maricris. You informed our audience that I'm excited. I'm always excited to present updates on the Philippine property market. And speaking of excitement, the Philippine economy has been seeing some excitement lately. 2024, we grew by 5.7%. And this is the second fastest growth in Southeast Asia, only behind Vietnam. The forecasts are looking very good, 6.1 to 8% for 2025. So that's pretty encouraging. What has been sustaining demand across
Joey,
the Philippines?
I think we need to reshare your PowerPoint. It's not showing.
Oh, okay. Hold on. Let me check that. Okay. Can you see it now?
Not yet.
Hold on.
I can see
I
your
see it
slides.
now.
Yes.
Okay. So again, let me just do a quick recap of what I discussed earlier. Philippine economy growing by 5.7% in 2024, and this is the second fastest growth across Southeast Asia during the year. And the forecasts are looking very good, 6.1 to 8% for 2025. If you look at the Philippine economy in general, so you have remittances that help lift spending across the country. And the good news is that a lot of Filipinos are still purchasing units, residential units. Whenever I go outside of the Philippines, you know, we have OFWs that continue to purchase condominiums as investment. And I'll discuss that in detail later. But what's interesting here is that these remittances continue to increase. So that's about 3% growth every year, and about $3 billion sent home by Filipinos working abroad. That is every month. Again, the good news is that inflation is starting to temper. And the 1.8% inflation that we saw March of 2025 is a 5-year low. First quarter of this year, 2.2% average inflation, so below the lower end of the forecast of the Philippine Central Bank, which is 2 to 4%, of course, and interest rates have been declining. So the basic policy rate is 5.5%. And again, this is pretty encouraging, especially for the investing public, for Filipinos acquiring residential units, because if we see lower interest rates and then lower mortgage rates, that will likely stoke the demand for residential condominium units, house and lot units across the Philippines. So if we see inflation further tempering, slowing, we are likely to see further cuts in interest rates, and that should have a positive impact when it comes to residential demand across the Philippines. Land value. So it is a mixed bag. It's a mixed story for land values because, well, as Kevin mentioned earlier, there are plans to rezone, redevelop Makati CBD, and that will likely contribute to a spike in land values within Makati CBD, the premier financial district. But that is not the same story for the Bay Area. For example, again, I'll discuss the residential vacancy later. But the Bay Area has been seeing elevated vacancies in the secondary residential market. In the office sector, more than 30% of vacancy. And that has been resulting in less appetite, stifled take-up for land across the Bay Area, therefore resulting in correction of land values. Stable land values and prices, that's what we're seeing in Fort Bonifacio as well as Ortigas Center. So this is breaking news, hot of the grill. The Department of Finance dropping proposal to raise capital gains tax from 6% to 10%. But I think what we really need to understand here is that if we, for example, if the government officials, lawmakers decide to refile it, I think this will have substantial impact on the property sector. It will likely harm investment sentiment across the country. It will reduce affordability in the residential sector. Imagine if you want to flip or resell your property and you factor in the additional 4% capital gains tax, you will be raising your price, and that will likely result in higher price in the secondary market when you decide to resell it, and therefore resulting in subdued appetite or demand for these properties that will likely be flipped. And given that, well, there are still some concerns about oversupply and condominium slowdown across the capital region. So that will likely exacerbate the situation that we are in right now. So the good news is that, again, the finance department has already dropped proposals to raise capital gains tax. And I hope, if we want to really raise tax revenues, perhaps the tax collection efforts, better efficiency in collecting taxes should suffice, or maybe look at non-tax revenues, including selling of government property. So let me now shift to the residential sector. The ready for occupancy promos are proliferating. We're seeing all these attractive discounts, payment terms being offered by developers left and right. We're seeing tempered launches for condominium units across the capital region. So less condos, vertical projects being launched right now. We're no longer seeing substantial launch of projects that we saw at the height of the POGO demand from 2017 to 2019. Again, another interesting development is the rezoning of Makati CBD. Will we see new retail spaces, new floors dedicated for offices, new hotels in certain locations that were not previously allotted for hotel projects? That is an interesting development, and we are definitely looking forward to this. However, we have mentioned some concerns that, of course, we need to address. The government officials, the private sector players can address moving forward. So I'll discuss that again in further details at the latter part of my presentation for the residential sector. In 2025, we will be seeing almost 9,000 new condominium units that will be completed. Interestingly, not a single condominium unit was completed or turned over in the first 3 months of 2025. But as you can see here, almost 60% of this new supply coming from a single location, and that is the Bay Area. There has been a relentless completion of new condominium units in the Bay Area. And in fact, those projects contributed to substantial delivery that we saw from 2017, 2018, 2019. This is, as I would always say, the POGO heyday. And developers really took advantage of the demand for great take-up for office space as well as residential units. So we saw a slowdown in 2020 because of manpower, lockdown restrictions resulting in stoppage of a lot of construction works. But these new projects will be completed in 2025 up to 2027. Note that these are the projects that were launched at the height of the pandemic, 2021, 2022, and are now being completed. So if you look at the average, 5,800 new units that will be completed annually from 2025 up to 2027. This is less than half the 13,000 units completed every year from 2017 to 2019. As we always say, and if you follow our reports, the Bay Area used to play catch up. It will now dominate, meaning it will now have the highest condominium supply across Metro Manila. It outpaced the total number of condominium units in Makati CBD in Ortigas 2018, mid of 2021. It was able to overtake Makati CBD, and for 2025, it will now have the highest number of condominium units, overtaking Fort Bonifacio. So if you look at this slide here, you'll understand why we saw substantial completion in the Bay Area, why the Bay Area is now on its way to overtaking Fort Bonifacio and dominating across the capital region. Imagine the three business districts, Fort Bonifacio, Makati CBD, Ortigas Center. The growth in new supply, new condominium supply from 2016 to 2025 would range from about 4 to 10% every year during this period. But look at the Bay Area, almost 50% increase in new supply, that is every year from 2016 up to 2025. And that has been resulting in elevated vacancy in the market, especially, if you intersect the supply versus demand figures. The Bay Area right now has been seeing elevated levels of vacancy, and I will discuss that later. But look at the entire Metro Manila region, the average vacancy, 26%. That is our projection for 2025, end of 2025, and this is a record high vacancy. But what I want to highlight here is that not all sublocations are affected by this level of vacancy. When you look at Eastwood, 5.8%, Rockwell, 10.6%, Fort Bonifacio, 19.3%, still sub 20%. Look at Makati CBD, 13.3%. So the more established business districts are definitely recording very good vacancy, pretty decent vacancy rates at this point, and even lower than the Metro Manila average. The concern that we have is because of the substantial completion in the Bay Area, and given that we're seeing stifled take up at this point, again, you no longer have a major demand driver. Which demand driver has been taken out of the equation? It's the POGO sector, and that has resulted in elevated vacancies. The POGO exodus has severely affected the office as well as the residential sectors. In fact, we're projecting by 2025, end of this year, the vacancy in the Bay Area will peak at about 56.5%. And we're monitoring this because if we see further decline in take up, this might even be adjusted upward. So again, it's not the same situation because for the more established business hubs, including Ortigas Center, Fort Bonifacio, Makati CBD, vacancies would range from 6.5 to 19.4%. The factors you're seeing here are pretty understandable. If you are a property stakeholder and if you've been following our reports and read the market intelligence reports that we always release on a regular basis, you know that the vacancy remains elevated because, again, we're seeing new completion, especially in the Bay Area. The POGOs have left the Philippines and have really left a huge gap, which remains to be filled partly or fully at this point. Vacancies for the office sector in Metro Manila have been increasing, as mentioned by Kevin earlier, almost 20%. So if I were a local professional executive living in Bulacan, is it still crucial, important for me to lease out a residential unit in Makati, for example, or Tigas, given that I can work from home? So that has been resulting in, again, elevated residential vacancy, less take up in the market, backouts in specific residential segments, especially for the mid-income, lower mid-income, 3.6 to 7 to 12 million pesos per unit. And what has been very instrumental in the market right now, yields remain flat. Meaning if you buy a condominium unit right now, will you be able to lease it out and make a decent yield, say about 5-6%? Yields peaked even before the POGO heyday, 2013, 2014, when yields would get about 6 to 7%. Yields right now are very low, 3-4%, 4% maximum. And that has been resulting in less acquisition, subdued acquisition or take up of condominium units that can be leased out in the market at this point. Because again, we have been seeing slowdown in terms of the demand for leasing in the market. Again, I mentioned earlier that there are proposals for the Makati CBD rezoning. So right now, when you look at Makati, it has one of the lowest residential vacancies in Metro Manila. I discussed that earlier, even lower than the Metro Manila average. But with this redevelopment, will we see new condominium projects being completed and replacing old structures, out with the old, in with the new? And again, if you look at the old FCC building, the old Mandarin Oriental Hotel, even the De La Rosa car park in Makati, there will be new projects that will be replacing these properties. So interesting, what is in store in the future, and what have developers lined up for the redevelopment of this Makati CBD, given that there are proposals for its rezoning. So these are the proposed Masaya land use amendments. Again, the establishment of super blocks system. What is very interesting here is that previously there were only certain locations in Makati CBD that are viable, ideal for hotel projects. Now you can build hotel projects again in more locations across Makati Central Business District. There will be greater floor area ratio that will be allocated for retail shops, which will of course benefit BPO employees as well as workers that do work overtime work. And we are also seeing more lots, developable lots that can be developed into mixed-use communities. And when we look at these parcels of developable land, there are certain developers that can really take advantage of these proposals to rezone and redevelop Makati CBD. However, and we always say this, of course, there are some issues that need to be tackled, some concerns that need to be addressed, especially in Makati CBD. Parking space is very difficult at this point, so these parking issues should be addressed. The efficiency of mass transit, for example, the Makati subway, its construction has stalled, and will the mass transit systems that will be built be viable and be adequate for the commuters within Makati CBD? Again, additional retail. There will be new retail spaces within office buildings, for example, ground floor retail. But will those be viable given that they are allowed to open up to extended hours? And will there be a market for these new retail shops and retail spaces? The proposal has also been calling for further sustainability, more LEED, green, well, better certified office spaces, residential towers. But are they providing incentives for developers to join the sustainability party and to encourage them and entice them to build more sustainable buildings and towers? So this is crucial, and we hope that these factors are addressed moving forward. Now, going back to the Metro Manila condominium sector, as you can see here, launches and take-up down. Imagine Q1 2025, only 5,000 units were launched during the first 3 months of 2025. Again, and I want to stress this, we're no longer seeing substantial launches and take-up, which we saw at the height of the POGO demand, 2017, 2018, 2019. Look at 2018 here, peak of condominium take-up in Metro Manila, 59,000 units. Look at 2024, only 9,000 units taken up, sold in the pre-selling market in Metro Manila during the year. So as you can see here, well, it's no longer surprising to see substantial declines in condominium launches and take-up. But when we looked at the data and further dissected, it appears that when you look at 2024, the data actually looks good, especially for the ultra luxury and upper luxury. So these are projects starting at 50 million pesos per unit. The take-ups are bigger, meaning greater than back-outs, resulting in net take-up. So that there is a net demand actually that we saw in 2024. And which segments? Well, particularly I want to highlight ultra luxury, which are at 100 million pesos per unit, and even ultra luxury, 50 million. That's why, if you remember, recall my slide earlier on Makati CBD redevelopment, it appears that, for example, some developers' proposals to build ultra luxury projects starting at 100 million pesos per unit would look and appear to be viable at this point, given that, well, the luxury market is still a relatively small market in Metro Manila, but it continues to grow. And as you can see here, there is net take-up, meaning the take-ups really dominating over backouts. In fact, when you look at this data, Again, we always say that the mid-income segment has been seeing some challenges in the market. But when you look at 2024 data alone, it appears that the take-up for lower mid-income and upper mid-income are in fact encouraging. For example, if you focus on lower mid-income, this is the 3.6 to 7 million pesos per unit, 3.2 to 7 million pesos per unit. There are more take-ups, in fact, in 2024. 5,200 versus 3,600 backouts, resulting in a net take-up. Upper mid-income, that is 7 to 12 million pesos per unit. More take-ups over backout, resulting in net take-up. So that is pretty encouraging. The concern that we have is that as of Q1 2025, that is not the same scenario that we are seeing, because it's the ultra luxury and upper luxury that dominated during the first 3 months of 2025. Unfortunately, we were able to record net backouts for the lower priced segments, including upper mid income and lower mid income, 3.2 to 12 million pesos per unit. But I want to highlight here that we have just started the year, first 3 months of 2025. Let's see if the take up, the net demand picks up and recovers for the remainder of 2025. So some of the projects recently launched, including the third tower of Avida Towers Makati South Point, so 7.8 million pesos per unit. The target completion is 2029. So already having its third tower, I remember 2019 when the first tower was launched. I was in fact invited by Avida to do a market presentation. Haraya Residences. This is the second tower, but total units launched 570 and the price per square 301,000 pesos. The average total price per unit 38 million. This is a luxury project. Required down payment is 5 to 30%. But again, if you focus on the down payment term, we're seeing that this is now the norm. The extended down payment terms, especially for Haraya, even the first tower, which was launched about 2023. So extended down payment, these is now the norm in the Metro Manila condominium market. This is in Tondo, Manila. So Urban Deca Tondo, Building 7 by Urban Deca Homes, 2.7 million a unit. Price per square, that is 87,000. And this is already ready for occupancy, an RFO project and financing, straight bank or through Pag-ibig. Now, this is what we want to debunk also. You're probably seeing some irresponsible bloggers saying that, the Metro Manila condominium market, it's struggling, it's a bubble about to burst. Well, we own the data, and what we want to highlight here is the fact that there are opportunities in the market, especially when you look at certain locations. For example, when you go to Quezon City and Pasig, take-up is in fact very good, 87%, 90%. When you go to the more established business districts, the take-up rates for pre-selling and even ready for occupancy, much higher, 93, 94, up to 96%. The average take-up all over Metro Manila is in fact 89%. So it only indicates that when you look at certain locations, it's a mixed bag, admittedly, but there are sub-markets performing much better compared to other sub-locations where we see some challenges in terms of take-up. Again, the most attractive locations at this point include Fort Bonifacio, Ortigas Center, as well as Makati CBD. When we go outside of Metro Manila, we're also seeing very good take-up rates. Cebu, for example, this is the biggest condominium market outside of Metro Manila. Take-up rates for condos, 88%. Davao, 90%. So when you go to Cebu, of course, some projects doing very well include Mantawi by RLC Residences. Of course, you have projects by Rockwell. Davao also doing very well. Damosa, for example, Torre Lorenzo. Cavite, so you have projects by Brittany Vista doing very well in Cavite, Laguna, and Batangas. with take-up rates ranging from 90 to 92%. Pampanga, 82%. So you have projects by Rockwell in Angeles City, Mega World in San Fernando, Fininvest within Clark Freeport. So overall, the average take-up rates for these locations, 76 to 92%. But when we look at specific projects, again, the data is pretty encouraging. When you look at Cavite, for example, you have projects by Brittany, Batangas, Lanco, Laguna, SM Prime, Pampanga, as I mentioned earlier, Rockwell. These are priced between 15 million to 22 million pesos among the more expensive projects in these locations. But take-up rates, in fact, doing very well, ranging from 60 to 80%. When you go to Visayas, Mindanao, especially Bacolod, Cebu, you have projects by RLC Residences, Mega World, also priced between 9 million to 16 million pesos per unit, with take-up rates ranging from 70 to 88%, almost 90%. And note that all these three projects were relatively recently launched, only launched in 2023. Now, again, I want to zoom in on the house and lot segment. Again, if you follow our reports, we always say that there has been a more pronounced shift to suburbia. And we're seeing that, in fact, this is supported by our data. This is Colliers Philippines data. And when you go to Cavite, very good take-up rates for house and lot units, 96%. Laguna, 93%. Batangas, 92%. If you also review and read our survey reports, there has been a stable demand for house and lot units, especially in southern Luzon region. And when you go to central Luzon, including Pampanga, Bulacan, there has been a very strong take-up as well. Again, the average take-up for these key provinces and cities outside of Metro Manila, 86 to 97% as of end of 2024. Again, a few examples, including those by Avida Land in Cavite, Mega World through its leisure subsidiary Jerry, and then Aboitiz Land in Batangas. These are priced at about 13 to 20 million pesos per unit, but take-up rates ranging from 60 to 100% for this Avida Park Lane project in Cavite. Now, when you go to Visayas and Mindanao, the figures are pretty encouraging also. So you have projects by Vista Land in Iloilo, Pueblo de Oro in Cebu. Pueblo de Oro is pretty encouraging because when you look at specific Pueblo de Oro projects in Luzon, for example, when you go to Pampanga, these are priced at about 2, 3, up to 4 million pesos per unit. But when they launched a project in Cebu, these are relatively bigger cuts, and the price is in fact a bit on the higher end, 7.5 million pesos per unit, more expensive than those projects launched in Luzon. And then you have King Properties and Hankyu Hanshin in Cebu. As you can see here, 9 million pesos per unit for a house and lot project, 85% sold already. Lot only. Again, there has been a strong take-up for lot only developments. And again, we previously discussed that one of the major drivers for lot only is because these projects are complemented by golf courses, golf communities, and then adjacent to this golf course is a residential project, and then developers offering a lot only project. And if you look at this slide, the take-up rates ranging from 52 to 97%. Again, no surprise here. Batangas, Cavite, Laguna, Pampanga, Cebu, recording very good take-up rates for lot-only projects ranging from 92 up to 97%. So when we took out specific examples, so you have projects by Alveo, Santa Lucia in Batangas, Rockwell in Bulacan, Federal Land, Nomura Real Estate. This is in partnership with the Nomura Group, a Japanese company. These are recording very good take-up also, 50% to 100% for the Samanian project buy Rockwell land in Bulacan. I remember back in 2024, latter part of 2024, I was even invited to provide insights to the investors of Rockwell. And seeing this figure already sold out only indicates a very strong take up for not only projects for Rockwell's development in Bulacan, but not only Rockwell, again, Albeo, Federal Land Mura. Look at the FNG's project in Cavite. That is 51,000 pesos per square meter, already 17 million pesos for a lot only project, but almost 90% sold. Again, Visayas and Mindanao, especially when you go to Bacolod, so you have projects by Rockwell, SMBC, Mega World, as well as Aboitiz Land in Cebu, priced between 2.6 to a high of 20 million pesos per unit. But these are also recording very good take-up, 40 to about 91%. Again, this is the more pronounced shift to suburbia that we have been saying. So you already saw our data. But when I shift to this slide, this is data by the Bangko Sentral ng Pilipinas, Philippine Central Bank. And this only proves that while the residential real estate loans granted to Metro Manila investors or buyers has been declining from its 48% share to total residential real estate loans granted by Philippine banks, Metro Manila's share dropped to only 29%. But when you focus on other regions, including Cavite, Laguna, Batangas, look at its share. It even expanded from 25 to 30%. Central Luzon increasing from 8% to 13%. Western Visayas, which covers Bacolod and Iloilo, increasing from 4% to 7%. So this is overall a very encouraging picture that we're seeing right now, especially when you go outside of Metro Manila. That's why it's no longer surprising to see a lot of developers really providing all these attractive RFO promos. The RFO schemes are getting more attractive, they're getting sweeter, because why not? It's one way of enticing end users and investors to acquire not just condominium but also house and lot only developments. In fact, some developers, for example, including DMCI, offering these RFO promos for their developments in Boracay, extended the lease terms up to 120 months for projects by RLC residences. For example, rent to own, DMCI allowing buyers to essentially rent a unit for up to 36 months and then giving them the option to buy after that 36-month period. And then SMDC, you pay a down payment of 5%, you move in to a fully furnished condominium unit. So overall, these are the headwinds and tailwinds that we're seeing in the market. The tailwinds, well, the more pronounced shift to suburbia. This is definitely a positive, especially for a lot of Metro Manila developers that are aggressively diversifying their geographic presence as well as aggressively land banking outside of the capital region. The more attractive RFO promos being implemented as they try to capture demand from local buyers as well as Filipinos working abroad. Then, of course, the rising popularity of leisure-oriented developments. Mega World is very popular for its wellness-themed integrated projects, including the one in Batangas, DMCI launching Montelio Crest, for example, in Benguet. This is the trend we're seeing right now. Lanco in Batangas. This is one of the major demand drivers, the demand for resort leisure-themed developments. Santa Lucia, Rockwell, all developers actually are taking advantage of this spike in demand for resort-themed developments. And again, this is a sub-segment of the residential sector that can really bank on the increasing number of domestic and even international tourists in the Philippines, and of course the sustained inflow of OFW remittances. helping drive the demand for residential units. If you remember, we would always say that the OFW market is a low-hanging fruit for developers. I remember, for example, RLC Residences inviting me to their briefing, exclusive property preview in Singapore and Hong Kong. Vista inviting me recently to their property briefing in Abu Dhabi, Dubai. So I see all those Filipinos really investing and acquiring these residential units. The percentage of remittance receiving households allocating money, setting aside remittances for house purchases has been increasing. This is the highest fraction that we saw since 2016. However, there are political concerns. And this is one of the major headwinds we're seeing in the market right now. What's happening locally or internationally. Of course, developers are always, wise enough to tune out the political noise. But I hope that, of course, these political issues are resolved soon. We will be having elections on May 12, and how will the new set of senators really shift or redefine economic policies that might also affect the property sector. So that is important. Will they finally, for example, pass the Right of Way Act amendments, which should help expedite the acquisition of parcels of developable land within and outside Metro Manila? Prices of construction materials have been increasing, even reaching a 14-year high in 2022, and that has also affected the affordability of condominium units, residential units across the country. Again, if you recall our previous presentation, condo prices, the cost of constructing condo on a per square meter basis growing by 14% annually from 2018 to 2023, when cash remittances would only grow by 3% every year, average salary increase only 5%. And of course, there's still a huge gap left by the POGO sector, and that has yet to be filled, especially for the condominium sector in Metro Manila. So this pretty much encapsulates the residential market that we're seeing at this point. And before I head to the retail sector, of course, I encourage you to please respond to our survey. I believe that we provided the QR code that you may scan. Again, the results of our survey, we will be compiling those, and we will be coming up with a report based on the results of that survey. So please respond to our survey. These surveys are not scientifically culled. We have a sample, of course. You are our respondents, not a scientifically culled sample or scientifically formulated questions. But these are very informative survey reports. But if you want to dig deeper and find out more specific data, you may always approach our advisory team, especially led by Tim Teodoro, and she will be part of the panel discussion later. So going to the retail sector, we're seeing relentless expansion from foreign brands, retailers of F&B, home furnishing. They are aggressively expanding within and outside Metro Manila. In fact, we're also seeing the shift to suburbia. They're not just expanding in Metro Manila. They're locating and aggressively taking up more space outside of the capital region. Developers are allocating 15 billion pesos, 13 billion pesos, 100 billion pesos, humongous figures for the refurbishment and upgrading of their retail spaces. But what's interesting also is that given that we're seeing some condominium slowdown in Metro Manila, developers are aggressively inviting home furnishing companies to invest in the Philippines. But there are opportunities, which I will discuss later. But all over the capital region, we have almost 8 million square meters of retail space. And as you can see here, much of this retail space right now located in the northern part of Metro Manila, followed by central and the western part of the capital region. There will be 158,000 square meters of new retail space that will be completed every year from 2025 to 2027. When you go to Quezon City, you have Filinvest Mall Cubao, Ayala Malls Park Links. When you go to San Juan, Mandaluyong, you have GH Mall South Wing, Arca South, Ayala Malls Arca South. So developers are really building new retail spaces across Metro Manila. And they're not just building new ones, they're refurbishing new malls, including Greenbelt 1 and Greenbelt 2. But speaking of expansion, this is a major expansion by the SM Group, 250,000 square meters of gross floor area added, completed first quarter of this year. It features a football pitch, an amphitheater, sanctuary, alfresco dining options, and a pool park. You have massive redevelopments taking shape, and developers have been earmarking billions of pesos. Imagine SM Supermalls, 100 billion pesos for its capex in 2025, and then allocating 21 billion pesos for mall expansion and redevelopment. Then even Ayala Malls, 13 billion pesos for the redevelopment, refurbishment, refresh of its flagship malls, but also setting aside 5 billion pesos for its malls in Davao, Quezon City, and Pampanga, which is the Marquee Mall in Angeles. Again, what we're seeing is that not just the expansion and construction of new malls, upgrading within Metro Manila, we're also seeing an aggressive push outside of the capital region. Imagine Rockwell building the first power plant mall outside of Metro Manila in 2027. This will be located in Angeles City, one of my favorite cities. Davao, Santa Lucia Mall, for example, Bacolod, Robinson's Land, and another power plant mall. So it's the shift to suburbia also that we have been seeing, not just for the residential sector, but also for the retail segment, which is Maricris's favorite sectors. The clothing and footwear and home furnishing segments have been seeing some recovery. So demand is now roaring back. They were affected previously because of high base effects, but what we're seeing now is the slower take-up for recreation and culture and restaurants and hotels. But this is also probably due to high base effects, given that these are the two segments that saw continued expansion in 2022 as well as 2023. Again, what has been seen in the Metro Manila retail sector is the massive expansion and take-up of mall space by experiential, immersive retailers. For example, a museum. You go to Ayala Malls Bay Area, you go to a museum, you look at the exhibition with your family, with your friends, with your loved ones. It has 10 attractions. Imagine this occupying 5,000 square meters of leasable retail space and the contributing to significant reduction of vacancy at the Ayala Malls Manila Bay. So the vacancy right now in the retail sector is 13.1%. Our forecast is that it will drop further to 13% for 2025 by the end of this year. So 13.1 already an improvement from 15.1% in the third quarter of 2024. No longer startling given that we have seen a massive expansion as well as take up from the experiential retailers. As we always say, these are the anchor tenants that continue to occupy massive retail space and resulting in a lower vacancy at this point. The good news is that we are likely to see pre-pandemic mall vacancy returning by 2026. Our forecast is that by Q4 of 2026, we will see a vacancy of 9.5%, even lower than the 9.8% vacancy we saw pre-pandemic, third quarter of 2019. So this is, again, another very good development for the retail sector. If there's one property sector that has seen substantial and continued recovery post-COVID, it is the retail sector. When you look at certain malls across the capital region, especially the super regional malls owned by major developers such as SM Ayala, they have very good occupancy rates ranging from 84 to 99%, virtually fully occupied. Again, our vacancy right now 13%. But given that some malls are recording occupancies of 98, 99%. How come we were still able to see and gather a vacancy of 13%? Well, some malls across the capital region have really recorded very slow absorption rate, very high vacancy rates ranging from 50 to 85%. These are probably some malls that refuse to renovate, therefore they evaporate. So if you look at vacancies across different malls across Metro Manila, especially given their sizes, much of the increase in vacancy really coming from the smaller retail formats, including district centers with leasable mall space of less than 50,000 square meters. Some drivers of vacancies include regional malls that recently opened, but we're optimistic that eventually these regional malls will see better mall space absorption, especially as we see again foreign retailers, home furnishing giants betting big on the Philippine consumer market. Now, when you look at new retailers that will be opening shop over the next 12 months, much of these retailers coming from FNB, covering almost 50% of new retailers, as well as fast fashion, beauty, and health, more than 30%. These are the upcoming retailers that we're seeing across the capital region. So it's a mix of F&B, personal accessories, home furnishing, for example, and again, we are optimistic that the government will be able to attract more foreign retailers soon, given the implementation of the Retail Trade Act amendments, meaning it is now much cheaper to open shop in the Philippines, paid up capital of $2.5 million previously. Now, this is down to $1 million. Again, F&B, clothing and footwear really dominating the Philippine retail market. And F&B, for example, will be covering about 42% of total foreign retailers that will be coming to the Philippines, and 33%, about a third of these foreign brands coming from clothing and footwear segments. What's again a positive development for the Philippine retail sector is that we're seeing massive expansion from the home furnishing giant. So, for example, Nitori, it started to enter the Philippine market 2024. It has 4 branches already. You have the likes of Flying Tiger Copenhagen. 2023, it has about 10 branches already, even outside of Metro Manila. It will be opening more soon. But what's encouraging also is Anco. It entered the Philippine market in 2024. It has massive retail space in Glorieta, but it will be expanding its third and largest store soon, and this will be located in Trinoma. More than 1,600 square meters of leasable retail space occupied by Anco. Even Muji opening its flagship store at Glorieta 3. Imagine 3 floors of Muji shop till you drop, and again, that Muji branch will be featuring a Muji bakery and coffee counter. Imagine also providing alteration and embroidery services. So this is one segment that we really need to watch out for. This is a very positive news for the Philippine retail sector because home retailers, home furnishing giants have been betting big on the Philippine market. And why not? We have a young, millennial, Gen Z dominated workforce. They will be buying their own units, building their own house and lots in the future. They will be needing home furnishing, of course. Again, remittances from Filipinos helping drive the take-up for residential units. And they will be requiring all these items from IKEA, Anco, Nitori. These brands are really expanding in the Philippines. What's interesting, again, is that the Philippine retail sector has become more experiential and less transactional. When you go to your favorite mall, do you just go to your favorite clothing shop, buy a shirt, and then step out of the mall? No. What we have seen is that when you go to a mall, go to your favorite coffee shop, or you go to the department store, and within that department store is a small, quaint coffee shop. You sip and then you shop. That is one trend that we have been seeing lately. That's why the likes of SM have been featuring coffee bean and tea leaf within their department stores. Muji Cafe already having 6 branches. Uniqlo Coffee 2 branches. Again, that experiential, less transactional tag has been prevalent across the Metro Manila retail sector, and is in fact resulting in greater take-up of physical mall space. Because when you talk about these retailers, they're not just occupying 100, 200 square meters of retail space. They're taking up massive physical mall space. The Michelin Guide arrived in the Philippines, and the projected release of its guideline is 2026. It will initially focus on Metro Manila, Cebu, Pampanga, and Cavite. Makati CBD, as I mentioned earlier, with its rezoning initiatives and redevelopment, new mall space will be added. Additional floor area ratio for retail means more options to shop for consumers, buyers, employees, and in fact, there will be active retail that will be mandated to open until 10 p.m. But again, I think what we need to check out here is the viability of the retail spaces up to 10 p.m., given that Makati CBD has a huge daytime population, but towards 5, 6 p.m., they go home already to nearby cities and provinces. So that has to be observed very closely. And again, we believe that overall, Makati CBD is still viable for new retail options because of, if you can see here, it has one of the biggest office leasable stock across Metro Manila. The vacancy for office is relatively low, the lowest, in fact, across Metro Manila. You have a lot of residents here that will be needing retail options. So I think this slide alone would indicate that, more retail space, whether local or foreign tenants, will be locating in Makati, and there's very good viability for these retailers to expand, open shop in Makati CBD. We are seeing a dynamic retail sector because we have a constantly growing economy. More developers have been refurbishing, upgrading their retail spaces, again, because they want the shoppers, the mall goers to stay longer and eventually spend more. The retail sector right now becoming more experiential. You do activities together, you play pickleball and do other activities within the events facilities of these major malls in Metro Manila. Again, the rezoning initiatives in Makati CBD will likely result into the welcoming of new foreign retailers and expansion of retail spaces across the central business district. And again, the proliferation of flagships, Muji, Anko, name it, and these foreign retailers have been expanding, and they have been taking up a massive, humongous retail spaces, therefore resulting in greater mall space absorption across Metro Manila. So overall, this is the situation that we're in right now. This is what we're seeing across Metro Manila. Whether you look at office, as Kevin mentioned, what really needs to be highlighted for the office sector is that pre-leasing of office space is back. We saw pre-leasing being stalled for the past 36 months. Now it's back, and this is a very good indicator for the Metro Manila office sector. The residential segment still seeing some challenges within Metro Manila, but the more pronounced shift to suburbia, complemented by the attractive RFO promos, payment terms offered by developers, have been resulting in greater take-up of residential units outside of Metro Manila. And of course, you have a very strong market to offer these projects to, including the OFW segment. Retail sector has become more experiential, less transactional. Again, we're projecting the Metro Manila mall sector to revert to pre-COVID vacancy by the end of 2026. The hotel sector is doing very well. Again, the last reporting more than 60% occupancies in Metro Manila, and foreign hospitality players are betting big on the Philippine tourism sector. Sofitel will be coming back, more Accor brands, Citadines, Ascott, aggressively expanding. RLC, of course, building a Philly hotel in Bridgetown. These are very interesting developments that we really need to watch out for and really excites travelers, business or leisure travelers across the Philippines. Industrial sector, we understand that there are opportunities, pockets of opportunities, especially with increasing tariffs being imposed by President Trump on our neighbors. But will that immediately result in greater manufacturing investments in the Philippines? Imagine, for example, Apple relocating much of its iPhone manufacturing from China to India. And will the Philippines be a beneficiary of this move by major manufacturers transferring their operations outside of China and looking for viable industrial locations? So this is an interesting development given that we have one of the lowest tariffs imposed by the US government. I think what we are seeing right now and what needs to be done is to really have a more pro-business environment, as well as the implementation of key reform measures that will help attract more foreign manufacturers, including manufacturers of EVs, steel, as well as fiber cement to the Philippines, and should result in greater take-up of industrial lots as well as warehouses, especially in major industrial hubs such as Central Luzon and Southern Luzon. So I think I already discussed much of the property segments, but again, I would like to remind you to answer our survey because we will be using the data for our survey reports, which we also use for our briefing materials, especially when we go to developers and do one-on-one and closed-door presentations with them. So hopefully you answer our survey. So that concludes my presentation. I'm gonna hand the virtual floor over to my colleague, Maricris. Chris?
Thank you, Joey. Very informative presentation. A lot of questions here, but before we start with the question, I'd like to call on Kevin back again and the rest of our panel. First, our Colliers Managing Director, Richard Raymundo, Senior Director of Capital Markets and Investment Services, Julius Guevara, Senior Director of Advisory Services, Theresa Teodoro, and Senior Director of Valuation Services, Paul Ramirez. So last April 23, we had Talakad. Joey, it's Kapampangan. I believe it means the rice. Is this correct? Talakad?
Well, if you say it slowly, talakad means stand up, and if you say it faster, talakad means to build.
Okay, so our first question is from Brian Suniga. Julius, this is for you. What do you think the effect if the president vetoes the proposed amended BCDA charter, which will allow the selling of lands freehold in the economic zones under BCDA?
Okay, that's quite interesting. I think it's going to be a status quo situation for the BCDA controlled areas where, they're just limited to land leases in terms of usage, or long-term land leases. So assuming that the BCDA, that bill which allows freehold is vetoed, then perhaps some of the foreign locators can opt for the longer land lease, which is being extended to 99 years, and hopefully that actually passes. I think it already passed the third reading in Congress, and I think it's now in the Office of the President level. So that would be another option.
Thank you, Julius. Paul and I were discussing about property values before the briefing. So, Paul, from Mercy Chua of Atram Trust, what are the tailwinds that will drive back property sales to pre-pandemic levels and will improve the valuation of properties?
Yeah, I think the question is two-part. First is the sales, to drive back the sale. So I think the developers right now are doing their part in balancing the supply and demand shift. So they're cutting off the tap of new projects, and as well as trying to unload some of their remaining inventory through creative payment schemes. So as far as the valuation is concerned, indirectly what we can do is what the government can do is maybe in the interest rate, lower the interest rate to make the properties more affordable. On more specific locations, what government can do is like what Masaya is doing. So they can improve the zoning and land use of the area. Infrastructure projects will also spur development and improve the values of properties as well.
Paul, another question from Jason Ongsip of SM Prime. How will the ongoing tariff war affect land condo valuation in the Philippines?
Okay, so tariff will not have a direct impact on the values. However, it will have effect on other aspects related to property, such as construction costs. So many construction materials are sourced overseas. Also, these tariff wars and other geopolitical uncertainties create economic uncertainties which shake investors' confidence. This can lead to slower economic growth and affect the real estate market as well. Tariff increasing the having this tariff wars increasing the pricing has an inflationary pressures which will likely result in higher interest rate as well, and uncertainties on this tariff also affect foreign investment, whether good or bad.
Thank you, Paul. For Tim, coming from Albert Oy of Prime Fit Construction, what would be the next growth driver of the Philippine real estate condominium in Metro Manila? Excluding the OFW market and low-end market, what would support the organic growth in this residential condominium sector?
Well, prior to 2017, the demand was really being driven by the middle income class. 2018 to 2020, that's really the entry of POGO. And so currently, and the exit really affected us after that, 2020 onwards. So right now, we haven't really seen another external factor coming in to replace that. However, the middle income market is still there, and the developers are proactive in recalibrating and making their projects more affordable, given their own cost constraints. So there's some limitations also to what they can do. So I guess anything that can help for this middle income market to participate in the real estate sector. I hope government takes a look at how they can support the market and the industry. Let's hope taxes like capital gains tax don't increase, interest rates are lowered, and even look into increasing the VAT exemption thresholds, because if I remember correctly, 3.2 million was the threshold already in 2012, and it's like more than 10 years, 13 years, and it's only at 3.6. So any improvements also on that can also help revitalize the middle income market.
Thanks, Tim. Another question from Tadeus Loterio of BSP. How are prices of horizontal developments impacted, particularly in the National Capital Region?
Sorry, again?
How are prices of the horizontal developments impacted, particularly in NCR?
Okay.
Horizontal developments.
Outside NCR?
In NCR.
In NCR, horizontal.
Yes.
Well, horizontal developments, there's really few already within NCR. So that's why a lot of the developments are really more condominiums already. However, there are some that are horizontal, but you already see their prices to be already in the luxury segments in terms of pricing, to ultra luxury. So, however, we also saw that because of the spillover for Metro Manila, that prices in Greater Metro Manila has also increased. We've seen prices in Cavite, Laguna, and Bulacan already at 30,000 to 60,000 per square for residential lot prices. And we've also seen activity moving and interest moving outside because of that. So we've seen increases in price in horizontal prices for NCR and also Greater Metro Manila.
Thanks, Tim. Joey, did you drink your water? Are you ready to take on questions?
Yes, I drank
Okay.
a liter.
Earlier, you mentioned that the OFW market is a low-hanging fruit for developers. Please expound.
Okay. So FW market is a low-hanging fruit for a lot of developers again because remittances continue to increase. Cash remittances growing by about 3% annually last year, about $35 billion. What's interesting is that according to the central bank and based on the results of their survey, the percentage of remittance receiving households allocating money for house purchases has been increasing. In fact, the highest so far, the highest that we saw since 2016. And you know this, Maricris, I just came from my UAE trip, Abu Dhabi, Dubai. So Vista invited me there. One of which projects are attractive? I'll give you an example. Kizuna Heights. This is in Manila. And for OFW investor, they think that it's a very good investment option because it caters to a niche market, meaning students. And of course, there will be a sustained flow of students that will be required in residential units within the university area. Another example, similar to the trend I mentioned earlier, Escana in Boracay. Even their Palawan projects are doing very well. Again, when you go to Singapore, Hong Kong, so RLC Residences invited me in Singapore and Hong Kong. Singapore, look at its size. It's one of the biggest markets, in fact, of developers. When I went to Singapore and Hong Kong and was invited by RLC Residences, which projects were very attractive. Their Lupon Residences within Bridgetown were among the most attractive options for OFW buyers. Even their Mira project in Cubao, Mira already on its second tower. This one project by RLC Residences doing very well. So these are the trends that we're seeing. When I go to these countries outside of the Philippines, I see the faces, the OFWs that are really investing. So this is, again, a very good market for developers to tap moving forward.
Joey, in addition to that, do we still see OFWs in the USA? I think your next trip should be USA.
Yes,
Here in the Big Apple.
that is correct.
Do we
Already
still see
applied for my-
OFWs in the USA
for
as a
my
strong
visa.
market?
Yeah, well, there are certain markets, there are certain developers here, in fact, catering to the USA market. I remember having presentations for Crown Asia and Brittany during ungodly hours because they were targeting the OFW market based in the United States. I understand that some of the international sales team, for example, of RLC Residences are now in the US because they're actively and aggressively marketing their projects to the US market. So this is still a very good market to tap. And even some developers, including Ayala Land, saying that they have seen a surge and uptick and take up from other markets, including US, for example, Australia, Canada, especially because these segments help fill, partly or fully, fill the void left by Chinese investors, which really acquired a lot of residential units from 2017 to 2019.
Joey, from Gazelle Zeta, there have been multiple articles in the media about it will take several years for the RFO inventory to clear effectively. Any direct effect on take-up been observed in the market's confidence in the residential real estate sector?
I discussed that earlier. So we even dissected which locations are doing very well, which property segments. Again, if you look at the luxury, ultra luxury, we recorded very good take up in 2024 specifically. The only concern is that for the first quarter of 2025, we're seeing a net backup for certain segments, but it's just the first quarter of 2025. Let's see for the remainder of the year. We might see greater take up rates, and we might still end 2025 on a positive note, meaning greater take-up for these residential units. What's interesting, Maricris, is that developers have been offering all these attractive RFO promos. Some, you don't even have to put in a hefty down payment just to be able to move in. You essentially just rent out these condominium units, and this already injects a lot of optimism into the market. One advice that I have for investors, buyers, don't believe the irresponsible bloggers out there. Because Colliers owns the data. We have the data. We dissect the data, and then we present it to you. That's why we're here and we're presenting. So if you're looking for information, just check out our social media pages and our websites. So I
Jury right on the page.
shamelessly, that's correct, and shamelessly plug our social media pages.
Thank you. So Kevin, we've been hearing a lot of very aggressive service offices, providers, new brands coming in, want to partner with landlords, giving them multiple options. Is co-working still viable in this changing landscape? Do we think we have too many service offices already? I mean, should a building have a service office facility in the building with all these options given to the landlord?
Oh, I actually got a comment yesterday in our face-to-face briefing that we don't have a slide on Flex, which we actually monitor as well. No, Flex is still a relevant product, and there's still a market for flexible workspace. No, and I think there's still some market space for that kind of facility to be present in not just in Metro Manila but also in the provinces, because flexible workspace is actually the quickest way to enter the Philippine market and establish a presence very rapidly. Some of these providers actually still even have a virtual office or staff leasing services wherein you can actually set up your business and hire people to work for you as soon as next week, for example. And for flex spaces also serve as an incubator facility, and this is actually very relevant if you want to test certain markets that you're still unfamiliar with. Like, for example, you for the longest time you've been here in Manila and you want to test a provincial market, and there's a provider there. Better to get a couple of seats in that private office with that provider, test recruitment in that location before you fully establish a full-blown presence in that market. And as well, the third, I guess I want to say the relevant use for Flex is really being near to your employees. No? So, for example, you have an HQ location in one of the CBDs in Manila, and you really want to tap to be near where your employees actually live, like in QC or south of Manila, and there's a provider there. You may consider doing a satellite setup or hub and spoke model with your entire operation. So I do think there's still market space, and with the influx of foreign more investments in the Philippines, I mean, the quickest way really to enter the market before you actually commit to a 5-year office lease is through a flexible workspace.
Thank you, Kevin. And just to add, like, for example, for our buildings that we handle in Makati, most of the flex office providers are in 90 to 95% occupancy in Makati, even in BGC. So landlords just could also take a look at occupancy levels per CBD. What are the CBDs that lack service office? For example, the Bay Area, there's a lack of service office providers in the Bay Area. So Richard from Raymond Gahol of MDR, considering the potential challenges highlighted in the briefing, what risk mitigation strategy should financial institutions and lender adopt when providing financing for the property development and acquisition in the markets during the remainder of 2025?
Well, I think one of the things that financial institutions are doing are they are rejigging the down payments sometimes, because we've seen some backouts in the data that Joey provided. And I know that some developers have rejigged it from 5%. They're now moving to a 10% down payment so that it becomes stickier. That's one thing that they are doing so that to get away from those risks of backouts moving forward. Because I think the backouts are coming from buyers with very low down payments and stretched payment terms. And now that it's being turned over, interest rates are higher than when they started, and vacancy rates in certain areas are very high. So they tend to just give up on some of the properties that they acquired before.
Rich, another question. BSP cut its rates 3 times last year, but the housing loan rates extended by the banks remains unchanged. What is the
Yes.
reason behind this?
I think it shows the risk. It's a reflection of the risk that some of the banks are being a bit more on the risk averse, given the oversupply. That's one, and given the softness in the prices. So I hope that, given that we've already cut the rates and our inflation, Joey, what was the last inflation? Was it 1.8?
1.8, sir. That's a
1.8.
5-year low. Yeah.
Correct. We're already at the 1.8% inflation, and your mortgage rate is still at
7.7.
Seven, yeah.
7.7.
Correct. So you can just imagine that the gap is still so wide. So it really shows you the risk that the financial institutions are still looking at in lending. I really hope that it starts to, as Tim said, that's one way to move the inventory is to make it a lot more affordable in terms of the mortgage rate, and also to make it easier for the buyers to get a loan. And this is why a lot of the developers are doing all of these RFO promos, wherein it is easier for a lot of the people to get into it. To get a loan these days takes a lot of documentation, and I think it's turning off a lot of people to enter into that.
Thanks, Rich. For the last question for Julius Guevara from Theresa Antonio of PMRB, what would you consider sunshine real estate development for 2025?
That's a tough question. I think, industrial continues to be a bright spot amid all of the challenges now today. Hospitality, I think there's a lot of interest in it. However, like, we're not getting the tourism numbers that we were hoping for, the foreign tourists. I think the bright spots, I think right now are really in the struggling sectors, because I think you can get good deals if you take a hard look at those opportunities, both on the residential as well as the office condominium sectors. I think that's where the opportunities are.
Thank you, Julius. Thank you to all our Colliers experts, Roi Bondoc, Kevin Jara, Julius Guevara, Paul Ramirez, Tim Teodoro, and Richard Raymundo for providing us with useful insights and recommendations as we face very promising months ahead. And to officially close our program, let's hear our final remarks from our Managing Director, Richard Raymundo.
Thanks, Maricris. I'd like to thank the panel and of course, Joey and Kevin for presenting amazing data for the first quarter. So we've seen office strengthening, pre-leasing is back, and in certain areas, it is a signal that we could be heading into a landlord's market in some of the areas. So that is pretty exciting. Residential, while there are challenges, we've seen a lot of opportunities. As Julius said, look into residential, look into certain areas wherein there's a lot of deals out there, RFOs, great deals for people to come in, and hopefully interest rates are going down and mortgage rates should follow. And of course, you have the retail market, which is still very strong, and we're getting a lot of new brands, exciting concepts in this sector. So a lot of good news. We like to look at the positives as well in the real estate market, and hopefully this will continue in the next quarter. So see you in the next quarter with more good news. And if you need some more information and insights into the market, please do reach out to us with the different people in the panel, and we'd be happy to help you. Again, thank you very much, and see you next quarter.
Maricris, we're flashing the survey.
Yeah, we're flashing the survey.
Okay.
Joe, and
Yeah,
then
Jeff,
is able
Martin,
to-
and Brent will flash the survey results. So let's look at the first question. Okay, so how important are green and sustainable features when leasing office spaces? Interestingly, nearly 50% saying it's an important and deciding factor. I remember yesterday, Maricris, during in-person briefing, which response dominated. It's the critical must be present option. Again, let's go to question number 2 for office. In which office setup are you more productive? Well, of course, traditional setup, about 2/3 more productive in the usual traditional office setting. And why not? Colliers Philippines, for example, we have a new office space. And if you enjoy meeting Maricris, for example, you'll be more productive when you work in a traditional office setup. Let's look at the next survey result, please. Which, with the changes in buyers' preferences, which of these would you like to have in your place of residence? So similar to the answer that emerged yesterday, it's really the good ventilation, large green open spaces. That's why it's no longer surprising to really see a lot of house and lot only projects doing very well, and especially those that are located outside of Metro Manila. Next survey question, please. So what type of property will you be acquiring in the next 12 months? This is pretty interesting. Condominiums dominating 40%. Yesterday, lot only segment was a top choice of our in-person attendees. So then we will be compiling the results, and we will be coming up with a survey report. So please do check your emails for the survey report. Do not unsubscribe. Make sure that you always open our emails. Next survey response, please. Which of the following items are you likely to purchase online? So through online shopping platforms, 40% choosing clothing and footwear, followed by groceries. So somehow similar to the response that we got yesterday during our in-person event. Next survey question: what should online shopping or e-commerce platforms improve on? Discounts and promos. This one I also like. I remember yesterday, it's the logistics delivery time that dominated the top choice of our respondents. Next.
Yeah, thank you everyone for attending our Q1 2025 Philippine Property Market Briefing, and we'll see you again next quarter.